Over the course of 4.5 years, a group of absolute novices generated an average annual return of over 80%. While he lacked financial experience, he had spent the previous 2 years programming an Apple II computer to test algorithmic trading systems. He already understood the value of rigid, computational testing over human guesswork. Finding an edge in financial markets requires executing algorithms with positive mathematical expectancy over thousands of iterations. This experiment relied on strict rules designed to remove human judgment from the trading system. To engineer a profitable system, you must understand why markets exist. At their core, financial exchanges are engines designed for the transfer of risk. Corporate hedgers, like an airline trying to lock in the cost of aviation fuel, enter the market to offload their business risk. Scalpers take the other side of that trade for a few seconds to capture the bid-ask spread. Speculators step in to assume the long-term price risk the hedgers left behind. This matrix illustrates the 4 distinct market states created by this transfer of risk. A market can be stable and quiet, stable and volatile, trending and quiet, or trending and volatile. The turtle strategy never attempts to predict which way the price is going to move. It only looks for mathematical indicators that a market has left a stable state and entered one of the 2 trending states. Traditional economic theory assumes that market participants act rationally, pricing in all available information. Behavioral finance shows that human beings systematically miscalculate probabilities and make irrational decisions under the stress of losing money. This chart shows exactly how predictable cognitive bugs manifest in the price action. Loss aversion causes traders to hold on to losing positions too long. The sunk cost effect prevents them from kiting those losses. Outcome bias causes them to abandon good systems after a few bad trades, and recency bias blinds them to the larger historical context. When large groups of traders panic and liquidate their positions at the exact same time due to these biases, they create sustained momentum. Trend followers do not create the trends. The algorithm's true edge is simply the mathematical exploitation of these predictable human flaws. Finding an edge is only the first step. A system must have positive expectancy, meaning it yields a net profit over a massive sample size. When your expectancy is positive, the outcome of any individual trade becomes mathematically irrelevant. Even a positive expectancy system will experience severe losing streaks. The probability of hitting zero equity during one of these drawdowns is called the risk of ruin. If you bet too large, a standard deviation string of losses will wipe you out before the probabilities can work in your favor. To survive these drawdowns, Dennis and Eckhardt introduced a system of volatility-adjusted position sizing. This split-screen chart demonstrates a metric called N, now known as the average true range. N measures the underlying daily dollar volatility of a specific market. By sizing positions based on N, you normalize the dollar risk across your entire portfolio. A highly volatile asset gets a smaller position size, and the low volatility asset gets a larger one. They carry the exact same mathematical weight. The turtles traded in units. A single unit was calculated so 1 N of price movement equaled exactly 1% of equity. If a trader hit a 10% drawdown, they were required to execute the dynamic equity rule. This reduced the nominal account size used to calculate those units by 20%. Automatically scaling down exposure during losing periods. Without this precise risk-sizing architecture, the risk of ruin approaches 100%. Money management ensures you survive long enough to let the edge play out. This logic gate schematic outlines how the system processed an incoming price signal. With risk strictly controlled, the entry and exit rules functioned mechanically, based on the channel breakout strategies popularized by Richard Donchian. The primary gate was System 1. If the price exceeded the 20-day high, you bought. If it dropped below the 20-day low, you sold short. You exited the position the moment the price breached a 10-day high or low in the opposite direction. There was only one exception. If the previous System 1 signal in that market would have resulted in a winning trade, the new signal was ignored. Missing a major trend was a critical error. So if you skipped a System 1 entry, you relied on System 2 as a failsafe, entering on a 55-day breakout and exiting on a 20-day reverse breakout. The system also utilized pyramiding, or scaling into a trade. Instead of buying a full position at the breakout, you bought one unit. For every half N of favorable price movement, you added another unit. This dashboard outlines the strict portfolio constraints designed to prevent catastrophic correlation failures, a necessary control because adding units creates immense leverage. You could hold a maximum of 4 units in a single market. You could hold 6 units across highly correlated markets, like gold and silver. Loosely correlated markets maxed out at 10 units, and you were absolutely capped at 12 total units in any single direction. These limits removed all discretionary thought. The trader did not analyze the news or forecast the economy. They acted strictly as an emotionless execution node. In February 1984, less than a month after their training ended, the heating oil market challenged the turtle rules in practice. This chart tracks the price action of the February contract. Curtis Faith noticed the price hit a System 2 breakout at 84 cents. He calculated his N, which dictated a unit size of 3 contracts, and he executed the trade. As the price steadily rose over the next few days, he systematically added units at every half N interval until he was fully loaded at the maximum 4-unit limit. Then, the market turned volatile. In just 2 days, the price dropped from 98 cents down to 94. Faith watched his paper profit drop from $50,000 down to $35,000. Many of the other turtles hesitated. Driven by loss aversion, they liquidated their positions to lock in whatever profits they had left, or avoided the trade entirely because of the rapid price movement. Faith held his contracts. The math dictated that the 20-day exit signal had not been breached. He ignored his paper losses, stayed in the market, and rode the resumed trend to a $78,000 profit. Faith generated 3 times the return of his peers, despite using the same rules. This discrepancy highlights that consistent execution remains the primary variable. The 1983 experiment demonstrated that the mathematical application of risk produces returns that human intuition cannot replicate.